This chart was predicting greater than $9,000 an ounce, but now that seems like an absurdly low price. Okay, hi, I'm Mike Maloney. I'm the author of the 2 best-selling books on investing in precious metals, and I have a gigantic presentation and not enough time. So Dan here, my producer-director, was trying to get me to just cut this down to a few frames, but you'll see it's pretty much impossible, and so that I could relax and not have to talk so fast. But my presentation is Protect, Profit, and Prosper During Chaos, Crisis, and Catastrophe. I do believe that there is a giant crash coming up. And so most of these presentations are laid out as problem, solution, and benefit. And this is basically the problems. The problems are that the financial markets are currently, I did a presentation in November of last year at Rebel Capitalist Live, and I took a lot of the important charts that show that we are in hyper bubbles from my book, and those charts are from October of 2022. And so in this presentation, I've updated just a few of the select charts that show how massive these bubbles are right now. And with every financial correction or crash, there is an opportunity. There is always an opportunity. In fact, I'd argue if you position yourself right, that the opportunity is such that you can make a whole lot more in a much shorter period of time than you can with traditional investments. And these crashes, when these bubbles pop, these super hyper bubbles, it's going to lead to a very bad economy. There will be high unemployment and high rates of homelessness, and it will probably lead to what I call financial crisis 2.0. Why is it 2.0? Because if you think that the global financial crisis of 2008 was bad, this is going to be more than twice as bad. And that will lead to political unrest, and it'll probably be global. We've seen rioting, and yet the economy is supposed to be doing well. That political unrest, what happens? What do leaders of countries do? What do the politicians do when there are things like crashes and a lousy economy, high unemployment, high homelessness? Do they raise their hand and they go, "It was me, I did it, it's all my fault"? No, they usually create a distraction. And throughout much of history, that distraction has been war. And you can smell it, you can feel it right now. We are like getting sucked into these wars in the Middle East and the Ukraine, and this is a very, very dangerous period of time right now. And so I want you to remember this, the bubble century, and then the saying, the higher the cliff, the bigger the fall. And so my first data here, this is the only way that you can measure the stock market that shows that it's not currently in the greatest bubble in history. We're right there right now. So we're in the 3rd largest bubble in history, but the valuations of stocks are much higher than 1929. This is the price-earnings ratio. So it's how many times the earnings per share per year that you're going to pay for it. It used to be that fair value was considered 12 or 15 times earnings. That was fair value for stocks. Now this is the S&P 500, so it's all averaged. It's a broad average of the stock market. But notice that red line. That used to be considered fair value. And actually, this indicator this is Robert Shiller's data. It goes back to 1881. And so fair value was very well established, and then everything went insane, and we are in the bubble century. This is where the global financial crisis started. It started at much lower levels than we're at today. And undervalued is down under 7. So what would happen if we had a crash that took us down to undervalued where it always went before? I do believe that with the next big crash, we've got all these people on the verge of retirement, and they're relying on their investments and their savings. And when you see people losing 50, 60, 70, 80, some will lose 90% of what they're counting on for retirement, that they're going to be very risk averse after that, and they're going to shy away from the stock markets. That's what causes undervaluations, when people shy away from this investment. But PE ratios are the only way that you can measure it that doesn't show it at historically overvalued levels. Nothing like this has ever happened. This is the Buffett indicator, so it's the value of, it's basically what is the dollar value of all the publicly traded stocks put together, divided by the entire economic output of the United States of America. And currently, the stock market is twice, the value of it is double the entire economic output of the United States. And there was a fair value range. I'll show you that in the next chart. But 50 to 70% is fair value. And what you see is the markets went down into fair value in 2008, but then Ben Bernanke, in response to the global financial crisis, created so much currency, and the way that currency is created, it has to be directed into the financial markets. When the Federal Reserve is creating currency, it goes directly into the financial markets. And then Jerome Powell, with his response to COVID, has pushed this into a bubble that we have never experienced before. This is the first time in history that we've been to this level of overvaluation. So that was the crash of 2008 that wiped out a lot of people. A lot of people were hurt in that. Look at the scale of the potential crash if we go to the undervalued area. This will dwarf 2008. This is proof that that Buffett indicator is correct. My researchers had to really dig deep for this one. One of them searched the internet, and it was like a month for him to find this paper by Dmitry Kuvshinov and Kaspar Zimmerman, two economists in Europe, that measured 17 advanced economies and created a Buffett indicator for the world going all the way back to 1870. And what it shows is that there was an equilibrium with the stock market and the economy, the price levels of everything else in society. And then in the late 90s, everybody went insane and started paying these multiples for stocks that were just insane. And this data ends in 2016. If I was to update this chart right now, it would go right off the top of the scale. This is the number of work hours. So this is automatically inflation adjusting. The number of work hours it takes to buy one share of the S&P 500. And the average used to be 23 work hours. Today it's 123. And this one goes back to 1860. The Civil War started in 1861. So this is very, very reliable data, and you're looking at it from a whole bunch of different directions now. And so when they all corroborate each other like this, what you've got is pretty much a slam dunk proof that this is true. The markets are incredibly overvalued, and for some reason, people connect the economy with the stock market now. If the stock market is doing good, they think the economy is doing good. It should be the other way around, but it's not. Now, most of you are real estate investors, and this is Dr. Robert Shiller's data on real estate. Now, I've been presenting this data since 2004. So in 2005, 6, and 7, I was with Robert Kiyosaki, and he was taking me around the world. He likes people that disagree with him. I was presenting this information, and I was saying real estate is going to have an enormous correction soon, and you have to get prepared for it. And most of the people ignored what I had to say because, it'd go on for another year, and there was no correction, and then another year, and then when I was finally proven to be right, a whole lot of those people were broke. Real estate fell by about 50%. And during that time, in 2008, gold bottomed at under $800, and by 2011, it was $1,900. So it had almost tripled at the same time that real estate fell by about half. This is proof that the whole system is crumbling right now. The whole financial system, the monetary system, is broken, and you don't have, I believe, that we don't have a whole lot of time left. What we've got here is bank reserves. There is a separate monetary system that the banks use that's not part of the monetary system that we experience. Every member bank of the Federal Reserve System has a checking account at the Federal Reserve. That's called bank reserves. And at the end of the day, they all do settlement. They pay each other and borrow from each other and so on. And so the bank reserves, it only took 40 to 50 billion of bank reserves to make the financial system run smoothly for decades. That's all they required. That's the upper left. The upper right is the interest paid on reserves. And there was no interest rate until 2008, so it's at zero. Then Ben Bernanke, when he did QE, he created a whole bunch of currency, a whole bunch of bank reserves. And to keep that from leaking out of the banks and causing inflation, he decided to pay interest on them. But when one man has the arrogance to think he knows so much that he can fix the economy with just his ideas, that comes back to bite you, because there's always unintended consequences. And he won the Nobel Prize for this stuff, and we are about to suffer the unintended consequences. The Federal Reserve buys financial assets that have to be guaranteed as to the principal and interest by the United States government. That's part of the Federal Reserve Act. So they're pretty much handcuffed to just buying U.S. Treasuries and mortgage-backed securities, and they have to buy them through a network of what are called primary dealers, the biggest brokerage houses on earth. There are always between 18 and 30 of them. But if you watch this, the Federal Reserve makes a profit. I don't have data before 2011 on the payments to the Treasury, but at the end of every week, the Federal Reserve is supposed to deduct their expenses, and then they pay all of their member banks, the stockholders in the Federal Reserve, a 6% dividend. Whatever is left over goes to the U.S. Treasury. The U.S. Treasury puts it into the general fund, and that lowers the deficit that week. If they don't get that payment, they then have to issue more U.S. Treasury bonds, bills, or notes that week and put us further into debt. And then what nobody has done, and I'm really surprised because, we came up with this, and it's in my book, and it's in a free chapter online that you can download and you can email it to anybody. But no financial analyst or economist has done this. You take the number of bank reserves times the interest rate that they're paying, and you get the amount that Ben Bernanke typed into existence and gave to the biggest brokerage houses on earth. Actually, it's their banks, their division. All of the brokerage houses have a bank that's connected with it. And so I'm going to start playing this now, and you'll see them all going live at the same time. And so the bank reserves are pretty constant. And then when 2008 comes on, you'll see interest rates go up. There's now an interest rate. There wasn't before. And you see that there's a few billion here that were paid to the banks, and nothing yet on the payments to the Treasury because that data doesn't exist. But all of these payments came out of your pocket. So now we're continuing, and we've had QE1, QE2, QE3, and you see the payments to the Treasury reducing the deficit so they don't have to indebt you more in the future with the national debt. And then this stops again in March of 2022. You'll notice that as the interest rate goes up, those payments go down, and then the interest rate's going to come down, the payments will start going up, and the amount of bank reserves, when Jerome Powell, when COVID happened and the pandemic, he made Ben Bernanke look like a little piker. That his response to it with the amount of currency creation in such a short period of time. But the interest rates are low. When the interest rates are low, those payments to the biggest banks and brokerage houses in the world sort of go flat. But then, in March of 22, he started raising rates at the fastest pace in history. And you'll see what happens next. So the banks here, I think that says $157 billion that they had been paid thus far. And there's still payments to the Treasury going on. However, they're lower than they would have been. Every week, some of it is going over to the banks. But watch what happens starting in March and then in September. The Federal Reserve went bankrupt. They are broke and they cannot pay the Treasury. So you'll see what they owe the Treasury and you're going to see where it went, and it all came out of your pocket. Now they go broke. They currently owe the Treasury close to $200 billion. And when you add that $200 billion to the amount that they didn't pay the Treasury each week before that they were paying the banks, the total is that you have been billed almost $500 billion. And whenever the interest rate goes up, it literally rains a deluge of free currency on the biggest banks and brokerage houses in the world. And you paid for it because those Treasury bonds, bills, and notes that were issued to make up for this are going to be paid for out of your taxes. So if you pay taxes, this gift that Ben Bernanke made to the biggest banks on earth came out of your pocket. This is a chart that shows that basically, I said this at George Gammon's Rebel Capitalist Live, we're screwed. When we go $1 deeper in debt, that's that red line. When the U.S. borrows $1 and the national debt goes up by $1, what do we get back? Well, after World War II in the 1950s, they would borrow $1 and we'd get somewhere between $6 and $8 worth of GDP growth. And this is where politicians have been sort of trained, that they can borrow and spend their way to prosperity, that we can borrow ourselves out of a hole, because it used to be true. But as we built up more and more debt, this has gone down and down and down. And then when Ben Bernanke introduced what I call Bernankenomics, when he changed the fundamental economics of how the world, the US monetary system, and thus the world monetary system works, this went negative in 2008, and it's been negative ever since. And today, this was updated just recently, and today, when we borrow $1, we get 50 cents worth of GDP growth. And so when all of the politicians do this amazing deficit spending that they are doing, and currently we spend about 35% more than our income every single month, and all they do is they dig a deeper hole for us, and one day the walls of that pit that we are in are going to start collapsing. But that creates a big opportunity. So will we have a stock market crash? I'm almost certain of it. That headline bloodbath is probably quite appropriate. Will it lead to higher unemployment and higher homelessness rates? I can almost guarantee it. I mean, I really think that this is lying out there in the future, and I don't think we have a whole lot of time. Will it lead to social unrest? Yes, I believe, we've already got rioting. What's going to happen when the economy gets really bad, high unemployment and high homelessness, is you're going to have a lot more conflicts going on around the world. So we're heading in to a period of extreme chaos. Now, the distraction throughout history has been to get involved in war. Are we going to? I believe so, because, you can smell it right now. We're right on the brink of it. We're being sucked in to 2 wars globally right now. And that is so that the politicians can say, well, it's not my fault. You've got to be patriotic and you've got to support this war, so you've got to support me. And it's just a distraction. But where does all of this pain and suffering and death end? Once this starts, the emotions build, and you just want to get back at the other guy. And so to keep this from escalating, there's no politician talking about peace. They're all trying to outmaneuver each other. And so how do we keep this contained? How do we keep it from escalating? History proves that this is a very difficult thing to accomplish. And what's the worst outcome possible? For the first time, back in the Cuban Missile Crisis, this was a possible outcome. And right now, we're always like minutes away from World War III now, with the Ukraine conflict especially. And so once this gets going, how do you keep it from running away? And will they? So you have to sort of, I'm preparing for the worst, but planning for the best, actually, because there is an opportunity in this. And I do believe that if we can get through just the next 5 years, that between AI, artificial intelligence, and robotics, that we have an incredibly bright future in front of us. That the economics, the monetary system, everything that we've been depending on is going to be pretty much irrelevant. And we're going to see levels of prosperity that we just can't even imagine right now. Or, I think it's a binary outcome. Or we end up dealing with a future like this, and that will plunge us into a dark ages, a modern dark ages, with the way, how intricate supply chains are and the monetary system, and then everything connected to that, even the education system. I just think that Elon Musk has warned about the possibility of a future dark age. So chaos plus crisis equals catastrophe, but I want to show you how I'm trying to turn it into my opportunity. And this is the great precious metals bull market of the 70s. I've turned it into a horse race. And the number 4 horse there is the stock market. If you had bet a buck on August 15th, 1971, when gold became free trading, on that day, and then this race ends January 1980, when gold and silver peaked, if you had bet on the stock market, your return would have been $1.40. So you bet a buck, you got $1.40 back, but was it the same dollar? We had double-digit, just raging inflation during the 70s. Actually, that $1.40 would only buy 30 cents worth of goods and services if you had spent the original dollar back in 1971. The $1.40 only bought 30 cents. So the actual purchasing power went down by 70%. Real estate didn't fare that much better. You bet a buck, you got $2.30 back, but it still didn't keep ahead of inflation. Gold, you bet a buck, you got $25.10 back. Silver, $41.30 from a single buck. To that date, that was the greatest bull market in history, only to be eclipsed by cryptos. What was the world like in 1970? Who drove the price of gold from $35 to $873? That was the actual peak in 1980. Well, up until the first day of 1975, it was only Canada and Western Europe. It was illegal in the United States and Australia. In first day of 75, it became legal in the United States. 76, Australia. Back then, news traveled really slowly. You'd turn on that old vacuum tube TV set on, and Walter Cronkite would tell you the price of gold, but you were using yesterday's news. That was 7:30 in the evening after the markets are closed. Or you could pick up the evening paper and get yesterday's news, basically. Or you could turn into the one and only financial program being made back then, Wall Street Week, with Louis Rukeyser on PBS Friday night after the week's trading was done, and you had to wait until Monday to take action on it. And if you wanted to buy gold, you picked up your phone to call your broker. He would call Chicago if it was the commodity. If it was gold stocks, he'd call New York and tell that office, and then they had to get a message to the floor trader, and you would be lucky if that trade got in on the same day. Today, it's only North Korea where it's illegal. So the number of people and the number of exchanges and markets around the planet, it truly is global. You know, back in the 70s, most of the rest of the world, Mexico, South America, the Caribbean, Africa, Southeast Asia, there were all these commercials on TV to raise funds to save all of these starving children in all of these countries. The famines that were going on back in the 70s and 80s, it was really global. So nobody there could afford to buy gold. Today, we've got all of these financial news channels. This is just a tiny little sample of where you can get financial news, let alone the tens of thousands of, like I've got a financial channel on YouTube. I've got 120 million views and 750,000 followers. But then there's X.com and Facebook and all of the, so it's 24/7, 365, and then you can get onto your laptop or check the price of gold on your cell phone, and you can buy gold while you're crossing the Sahara on your camel today. So this frame I forgot to take out, I'm sorry. Today, the number of billionaires on the planet, there are more than 600 billionaires in the US and in China. The green countries, it's 50 to 599, and the blue countries, there are countries in Africa today where everybody was starving to death back in the 80s, now that have 10 billionaires in that country. According to the OECD, there's 55 times more currency on the planet. We keep on creating currency. There is $16 trillion in the United States alone sitting on the sidelines waiting to go somewhere. And I believe that when there's a crisis, people seek safe havens. They have been taught to seek US Treasuries normally, but the US Treasury is starting to become suspect. Are you going to be paid back if you loan your currency to the United States government for 5, 10, 20, 30 years? People are starting to realize our levels of debt to GDP and the population demographics sort of say that no, you're not going to get paid back. There are now 18 times more people who can buy, 55 times more currency, 56 times more millionaires, 200 times more billionaires, and 220 times more available consumer credit than in January of 1980 when gold peaked. Now, silver isn't even, it's still, it's a little more than half of its 1980 high. Name something else that's still selling at a discount to its 1980 price. Okay, it advanced 2 frames accidentally. I had my chart guru, Alan Hibbard, create a chart where he lined up the S&P 500 and gold on the day that gold bottomed from its 1980 high to today. What was the lowest price? And the performance of the S&P, it's up almost 300%, but gold is up almost 900%. Why would anybody take all the risk that is involved? Gold is an asset you can hold in your hand, and it requires no counterparty to make it good. If you were in stocks and your brokerage house was Lehman Brothers, what happened in 2008 to your portfolio? It vanished. It requires the performance of a counterparty. Gold does not. There's something called Elliott wave analysis. I had Alan line up on the day that gold bottomed, the previous bull market in gold, the 70s bull market, that's the blue scale and the blue line, with today's bull market that started in 1999, the orange scale or yellow, and the yellow line. And when we did that, I had him then squeeze today's bull market in time and in magnitude, and when the 2 peaks, it's called Elliott wave, where markets will go up in a 1, 2, 3 pattern, or they'll go up in 5 waves. And when we saw this, we went, oh my God, this is greater than a 0.97 correlation, meaning that it is more than 97% the same. It was echoes of the past. But this was for my book, so the chart was done in October of 22. Where has it gone since today, and what happened? There's a divergence there. Why? Well, we had the pandemic, and then we had massive currency creation, and then massive inflation, and gold sort of yawned and went sideways. Well, I believe that that is just storing energy. It is storing the energy of all of that inflation and currency creation, and with the next crisis, it is going to explode, and that energy will cause it to go right off the top of this chart. This chart was predicting greater than $9,000 an ounce, but now that seems like an absurdly low price when you measure the quantity of gold that we have against the expansion of the currency supply, against prices. In fact, in 1999, gold was $250. Now it is $2,500. The gold didn't change. The dollar lost 90% of its purchasing power against gold. And you just have to ask yourself, do you think the dollar is going to gain value against things? Do you think prices are going to go down, or are they going to... Will the government and the Federal Reserve get a hold of themselves and stop creating massive amounts of currency? And so if you want to know more about it, go to ggsr21.com, and there there's these online chapters. Read those, download them, send them to anyone you want. It's free, and we don't even ask for your email address. This is something that you can do right now. Chapter 3 is the easiest chapter to read, and it'll benefit you for the rest of your life. It's real simple, and it's about how somebody that creates a chart can create that chart to lie to you or skew your perception. Chapter 4 is the hardest. If you want to understand how currency is created, and how the global economy works, and how the world's central banks and the banks enslave you and constantly suck what I call economic energy out of you, suck wealth out of you. Chapter 4 is the chapter. It's not an easy chapter. It's written in 7 parts. But go to ggsr21.com and goldsilver.com. There is a wealth of information on both websites. So, problem, solution, benefit, and hopefully I just helped you change that to problem, solution, jackpot. So the 5 Gs. Robert Kiyosaki took me around the world from 2004 to 2010, speaking to audiences all over. And he likes people that disagree with him. And I got the nickname, the Angel of Death, back then, because I would sort of depress the audience with my information. But you know, I was showing them real estate was going into a bubble, the stock market's going into a bubble, you got to get prepared, and then the global financial crisis of 2008. Well, we're at that point right now, but as you've just seen, it's much bigger than before. Robert would talk about how to become super resilient, and that is the 5 Gs. You have ground, grub, gas, guns, and gold. Well, I've already got the gold. But I'll show you what I'm doing to get prepared. I'm making a bet on the upside and a bet on the downside. So I'm preparing for the worst, but planning for the best simultaneously. So that wraps up the first part of my presentation at the Limitless Expo in Dallas, Texas. In the coming weeks, I'm going to show you how I'm preparing for the worst, but hoping for the best, with the rest of this presentation and an update on the farm. So if you got anything from this video, please like and subscribe, and we'll see you next time.